Hello, Todd Lowry with Prime Lending. The question was asked, what is mortgage insurance and do I need it? So mortgage insurance, usually you think of it as PMI on a conventional loan. That's what most people think of. And it's a cost that you potentially incur if you're not putting 20% down. Okay. Now there's all kinds of programs around it, but the generic, easy, quick answer is if you're putting 20% down, you typically do not require mortgage insurance. If you're putting less down, you do. And that's all based on risk tolerance with lending, right? So if you're buying a house for $200,000, that's usually the example that I use, and you're putting 20% down, you're putting $40,000 down, you're only financing $160,000. Let's say 6 months from now, you lose your job and you can't make your mortgage payment and the lender has to foreclose on your home, right? They have to try and get the home back from you and sell it and, cut their losses. If you put 20% down and you only finance 160, a house that was worth $200,000 6 months ago, we can probably get our money back if we only lent you 160. Let's say you put 5% down and you actually borrowed 190, right? Well, it might be a lot tougher to get 190 out of it, right? Maybe you paid a little more than most other people pay. Maybe the market softened a little bit in 6 months, right? There's a lot of reasons why it would be more difficult for the lender to recoup their money. And so with that risk, you actually pay mortgage insurance, which actually backs the lender, it covers the lender. So if we go to sell your house and we can only get $175,000 for it 6 months later, because that's just what the market says it's worth at that point in time, and that's what anyone will offer, whatever the scenario is, we're covered because we had insurance. That mortgage insurance is insurance that covers us for the fact that we lent you 190 and now we can only get 175 back. You pay a monthly mortgage insurance that insures us as a lender. FHA loan will also have their version. It's called an annual MIP. It's at a set rate, right? USDA loan has its own version. USDA loan requires 1% up front, and then I think it's 0.35 percent of the overall loan amount each year spread out over 12 months. All that kind of stuff varies depending on the different loan types. On a conventional loan, the mortgage insurance is going to be based off of how much did you put down, how much of a gap are we trying to insure between what you put down and the 20%, and then what's your credit situation, some other things like that. All are factors that go into how we assess what that monthly amount is. If you have any questions, there are sometimes ways that you don't have to do mortgage insurance, even if you did put 20% down, or you can pay it up front. There's some things, some programs potentially where we can get around it. But essentially, mortgage insurance is typically thought of as, I'm doing a conventional loan, I didn't put 20% down, now I got to pay a little extra every month to mitigate the risk that's been taken on by the lender.